Part 2, the 6 categories of stocks and how to spot winners. Welcome back to part 2 of our deep dive into One Up on Wall Street by Peter Lynch, a book that has empowered millions of individual investors to think independently and beat Wall Street at its own game. In part 1, we learned about Lynch's core philosophy, that everyday investors can outperform professional analysts simply by paying attention to the world around them. Now in part 2, we'll go deeper into Lynch's unique way of classifying stocks and how that helps you build smarter strategies. Let's start with Lynch's famous 6 categories of stocks. This isn't just a cute framework, it's a powerful tool to evaluate any company. If you know what type of stock you're dealing with, you'll know what to expect and how to make better decisions. Category 1, slow growers. These are big, mature companies, often former fast growers, that have settled into predictable but limited growth. Think of old-school utilities or legacy businesses. They may not double your money quickly, but they usually pay decent dividends and can be solid during uncertain markets. Lynch typically avoids slow growers unless he sees a very compelling valuation or turnaround story. Why? Because they rarely surprise to the upside. But if you're a dividend investor looking for income, these may play a small role in your portfolio. Category 2, Stalwarts. These are large established companies that still show decent growth, typically 10 to 12% annually. Lynch likes Stalwarts because they're stable, understandable, and often undervalued during temporary setbacks. Examples: Coca-Cola, Procter & Gamble, Johnson & Johnson. Stalwarts are solid in a downturn. If the stock price dips because of a bad quarter or news that isn't catastrophic, it could be a great opportunity to buy. Lynch's tip: buy Stalwarts during market panics or when they fall out of favor temporarily. Category 3, fast growers. Now we're talking. This is Lynch's favorite category, and where he found most of his legendary tenbaggers. Fast growers are usually smaller companies, sometimes in niche markets, growing earnings at 20 to 30% or more per year. But Lynch warns, not every fast-growing company is a great investment. You still need to do your homework. Ask yourself, is the company expanding into new markets? Are they profitable or just growing revenue? Can they sustain their growth or are they burning cash? Example: in the 1980s, Lynch spotted Taco Bell early because it was aggressively expanding and becoming a national brand. That's the kind of insight you can catch if you're paying attention. Category 4, Cyclicals. Cyclicals are companies whose business booms when the economy is strong and struggles during recessions. Airlines, steel, autos, and hotels are all classic examples. Lynch emphasizes that timing is key with cyclicals. You don't buy an airline at the peak of a travel boom. You buy it when the economy is recovering and demand is about to surge. You need to understand where you are in the cycle. Look at earnings trends, economic indicators, and how past cycles have played out. This is not a buy and hold category. It's all about entry and exit timing. Category 5, turnarounds. Turnarounds are companies in trouble, maybe losing money, maybe facing industry challenges, but with a clear path to recovery. These are riskier, but the rewards can be massive. Lynch calls them no growers that suddenly grow again. Example: Chrysler in the 1980s, or companies that streamline operations, bring in new management, or sell off bad divisions. But be careful, many troubled companies never recover. Lynch looks for signs like new leadership, debt reduction, strategic restructuring, returning to profitability. Category 6, asset plays. These are companies with hidden value the market has overlooked. It could be real estate on the books at outdated prices, large cash holdings, undervalued brands, or patents. The trick is finding these hidden assets and verifying their value. Lynch loves small-cap companies where he could dig through the balance sheet and find surprises, like land worth more than the company's entire market cap. So why do these categories matter? Lynch emphasizes that you need to know what you own. If you think you found a fast grower, but it's actually a cyclical near the top of its cycle, you're setting yourself up for disappointment. If you're buying a turnaround, don't expect it to skyrocket in a month. These things take time. Understanding what type of stock you're investing in helps you manage expectations and not panic when the stock doesn't move how you hoped right away. Lynch's stock picking advice. At this point in the book, Peter Lynch starts to share more of his practical advice for finding great stocks. Some key insights include: ignore macroeconomic predictions. Lynch doesn't believe anyone can predict interest rates, recessions, or market crashes. Don't base your decisions on what economists are saying. Focus on the company itself. Do your own research. Lynch wants you to build a personal story for each company you buy. You should be able to explain in plain English why you own the stock, not just "I heard it on the news" or "my friend bought it." Focus on earnings. Long-term stock performance is tied to earnings growth. If earnings are rising steadily, the stock price usually follows. Look for low debt. Companies with low debt can survive downturns better and grow more flexibly. Insider buying is a good sign. If executives are buying shares with their own money, they probably believe in the company's future. Let's wrap up part 2. Peter Lynch gives us a framework that's simple but incredibly powerful. By classifying stocks into 6 types, he helps you know what to expect and how to invest with clarity. In part 3, we'll explore the common mistakes investors make, how to read financials the Lynch way, and how to build a portfolio that actually works. If you're enjoying this breakdown, hit the like button and subscribe so you don't miss what's next in our Peter Lynch investing series. See you in part 3.